Today I'm going to show you my outlook for 2026. I've compiled an outlook from the top institutions in the world and what their take is on for S&P, gold, silver, rates, and I'll go through some key themes to consider in 2026, and finally I'll jump into sectors to strongly consider and those to avoid. Let's jump in. All right, so this is the S&P. This is going back to 2024 and all the way through today. As you can see, we've been in a strong uptrend over the last couple of years, and looking at the forecast by several of these top institutions, their forecast is about 8 to 10% higher from where it is today. Oppenheimer is the most aggressive and the most optimistic, with the S&P closing around 8,100 towards the end of next year. That's nearly a 17% increase. And then all the way down here at the bottom, you got Wells Fargo with a year-end closing price of around 7,200. And then everyone else is somewhere around the middle. I personally agree with most of these numbers. I tend to think somewhere around that 8 to 10% is that target. Now, the way we get there, you may have a lot of ups and downs, but eventually we should end around the 7,500 mark next year, or maybe a little bit higher. One of the big things to consider over the next year is the AI narrative. We're moving from the AI build out to now prove that you can monetize AI. That is going to be a big driver with these companies over the next 12 to 18 months, as now we have to prove that we can make the money that we said we were going to make. So that's going to be a narrative to really keep an eye on. As far as interest rates are concerned, the Fed, we know, has indicated they plan on doing one cut. I personally believe it's going to be probably 3 or more cuts for 2026, but looking at some of the other analysts, they're thinking somewhere between 1 and 3. And you can see with like the Federal Reserve, they, as I just mentioned, 1 cut. Goldman Sachs is 2 cuts. BlackRock 2 to 3 cuts. TD Securities thinks more than expected, which would mean more than 2 cuts. And then Charles Schwab, they're the most conservative with probably 0 to 1 cut, because they believe that inflation is going to remain sticky. Looking at what's currently priced in, we have a 15% chance of a rate cut in January, with the most likely cut being priced in April. And then you've got another cut in September. Powell leaves in May, and I think Trump's going to find someone that is definitely aligned with him. And Trump wants interest rates cut by 200 to 300 basis points from where they are today. So that's going to put a lot of pressure. If he finds someone that's aligned with them, can that new chair convince the rest of the people to cut rates? Looking at where ZQZ, the end of 2026, where that is priced in, it's right in between the 2 and 3 cuts. But depending on who you ask, it's somewhere in this range. Taking a look at gold, going back to 2024 to here we are today, January 1st, 2026. We've had a 64% year-to-date run with gold. What a phenomenal run. It appears that gold still has more room to run, with most analysts targeting around $5,000 an ounce. Today, we're at $4,300. And it's going to potentially go to 5,000. Some of those support drivers is you have central bank buying. There are other central banks around the world that are trying to decouple from the dollar. It's called de-dollarization. And these central banks, think Thailand, India, Turkey, Kazakhstan, those type of central banks, they used to hold dollars in their reserves, and now they're swapping it out for gold. And that is to bypass the effect of tariffs. Even China, they're recycling their treasuries and swapping it out for gold. So there's a huge demand for gold, and that should drive the prices higher. It will definitely provide support. So I don't expect any kind of significant retracement from where it is today. And given the economic backdrop, gold is also a good safe haven asset. And if there's any kind of economic slowdown, you'll see a pouring into gold. So that will be supportive of gold prices. Let's take a look at silver. Same thing with silver. It has had a massive run up. We are 147% year to date on silver. You've got some issues underlying, like a structural supply problem. There's actually a supply deficit. It takes 10 to 15 years for silver to come into production. And right now, silver is not just used for jewelry. It has several other applications within the ecosystems. You've got 17% of silver is used for jewelry, 4% is used for silverware, 24% think of silver coins and people buying bullions and things like that. 24% is for that, 2 to 3% is in photography, and then 50% is industrial. So you have a huge industrial application. Think EVs and solar cells, big demand, and it's not going away. And then you've got a supply problem where you have a deficit. You have more demand than there is supply. And once you know where the mine is, it takes 10 to 15 years to bring that online. So this is going to be a very big support for silver. And over the next year, many analysts are expecting somewhere between $95 and $100 an ounce. And today we're at 70. It could pull back a little bit. Many analysts are expecting $50 an ounce is the new support level. So if you get any kind of pullback, maybe a decent time to add silver. Take a look at this. This is the gold to silver ratio. Typically, if you can see this little line right here in the middle, typically the gold to silver ratio is about 80. What I've got drawn out in the last 10 to 15 years, it's 75, which means that gold is 75 times more expensive than silver. What you're seeing now is a gold to silver anomaly because silver demand is much higher relative to gold. This here is a trade potential, but I wouldn't do it yet. Silver has more room to run if it goes to the $100 an ounce and gold goes to $5,000 an ounce. You'll see that compression go down a little bit further. So rather than being a 60 on the gold to silver ratio, you can see that go down to 50. If it goes down to 50, that may be the time, and it could take another year before we get there, that may be the time to actually put in a trade spread that would take advantage of not the precious metal component, but the industrial component. You'll see this go back to normal and go back to that 70 to 80. At this point, you don't care which way the prices go. You only care that the ratio goes back to normal. So keep an eye on this one. Another thing to consider is inflation. Right now, it's above the Fed's 2% target. We're roughly 2.8, 2.9. This needs to get down to the 2% goal. But most analysts believe the realistic range right now is somewhere between that 2.4, 2.8, which would be the 6th year inflation is above its target. This one will be one to watch because you've got tariffs that could complicate things, uneven application of tariffs. You've got housing supply that's locked in lower rates, so people that have lower interest rates on their houses are not selling. I think the inflation job is done, and we also have lagging effects of interest rates coming down. So keep an eye on inflation. It's definitely a risk to consider. Now I'm going to jump into the individual sectors and which ones should perform and which ones I would avoid. What I've got drawn out here is the year-to-date performance for each of the sectors from tech, communications down to staples. This is beginning of January 2025 and where we are today. And you can see tech definitely outperformed at about 25, 26%. And staples and energy definitely underperformed only at 1%. So who's going to perform better in 2026? Financials from the perspective that the yield curve is steepening. You've got deregulation. All of that's going to help and be a tailwind for financials. Technology is going to continue to do well from the AI build out, as well as if companies adopt more AI and get the productivity increases, that should perform well for the technology sector. Is it going to perform as well as it did last year? I'm not so sure about that, but I still think you've definitely got some positive room for growth. From an industrial perspective, you've got the continued AI build out, some defense spending, as well as some reshoring of manufacturing if manufacturing does come back online. Healthcare is going to continue to do well for several years as you have many baby boomers that are beginning to age and they're going to need the healthcare component. And then you've also got AI adoption within the healthcare space. So you should see healthcare do very well. Utilities is a good play because of its defensive nature as well as dividends. They usually pay pretty well dividends. The risk there is you've got interest rate sensitivity. So if rates do jump unexpectedly, you could see a fall in the utility space, but that's typically a pretty good play and should do pretty well as the Fed is easing rates and we go into QT. Communications should perform very well due to content costs, creative costs, things like that. And it actually did very well this last year and should continue to do well. Energy, I would be selective on that. The natural gas component should do well. Materials, especially on the copper side. Copper, you need copper for the AI build out. There's a huge demand for copper. And so think companies like FCX, we've talked about that one in the past. That should continue to perform well. COPEX is an ETF for copper, and that should perform well because there is a huge demand for copper with all of this AI. Consumer discretionary and consumer staples, I would avoid. Those did not do well last year. I don't think they'll do again this year with the K-shaped economy and the bifurcation between higher income and lower income. The lower income represents more of the economy, and they are being squeezed with inflation and limited wage growth. and that's going to have an impact on staples. So I would definitely avoid staples and consumer discretionary. So overall, I'm optimistic on several different parts of the economy, everything from interest rates. I'm in the camp of lower interest rates, which is going to be great for equities. I'm in the camp of higher gold prices. I don't know how much higher, but definitely silver should go up from here. But there's some things to watch. Definitely look at valuation. Valuation is very high on the S&P, and a lot of those earnings have been brought forward. If the AI narrative stays about where it is, we should be good. If companies adopt AI and margins improve because of AI efficiencies, I think that'll be very good and should be also good on the S&P just overall. But if the AI narrative shifts and we see more circular financing, and what I mean by that is the hyperscalers, they are investing into startup companies, but those startup companies are in turn buying infrastructure and buying hardware from the very companies that invested into them. So it's kind of like the companies buying their own stuff. And that's circular financing. That is a risk. Keep an eye on that narrative, because if that does continue to shift, you could see a pullback. You also have midterms, elevated uncertainty there. The AI bubble, which I just talked about, inflation. If it rears its ugly head, I don't think it will, but it is a risk and it's something to keep an eye on. Geopolitical shocks, as always, that can have an effect. And then Fed policy error. What if they kept the rates too high for too long? Or if they drop them too fast? Those could definitely have some effects and some volatility within interest rates. So bottom line, watch the narrative around AI, keep an eye on interest rates, keep an eye on inflation. And in the end, equities should perform pretty well, but stay nimble, be active, and explore alternatives. Diversify into real assets. And then consider dividend growth. Look for some of those defensive characteristics that we talked about earlier. Bonds will provide a return, but they won't provide as much of a return as they did in 2025. I'll continue to trade opportunities as I see using derivatives, but for the long-term investor, diversify, dollar cost average in. I hope you enjoyed this video. With that, happy trading, good luck, and we'll see you next time. Thanks, have a great week, and Happy New Year.